Okay, so just real quick, I want to introduce my crew, and then we'll just kind of do a run through with everybody. Everybody can introduce themselves, tell a little bit about what they're doing and what they hope to be doing. And then we will have the crew from Pacific Equities go ahead and take it over and talk about all their products and all the cool things that they do. And we'll go from there. So starting with myself, I'm Kevin Romines. I'm the branch manager for Geneva Financial. I do conventional loans. Conventionals are your Fannie Mae, Freddie Macs. I do all your government loans, FHA, USDA, and VA. I also do a lot of hard money throughout the year for all my flippers. And then it depends on their disposition. If they're going to refinance and hold, then they'll do that. And most of the time they'll flip it. And then, of course, we're looking at also some commercial things. And so those are the kinds of things that I do. I do a lot of commercial too with our commercial crew down in our headquarters in Arizona. So I can get all over the country a little bit sometimes on the commercial side. I am getting requested to get licensed in multiple states. So I'm going to go ahead and do that. And that way I can keep up with all my Bigger Pockets requests. For every time somebody sees me on Bigger Pockets, they want me to do some loans, but I don't happen to be licensed in that state. So I give them away like candy for now, but I'm eventually going to go ahead and do that. Terrell, do you want to introduce yourself? You know, of the upgrade?
I am now officially a loan officer. So going to be using Kevin as a mentor to try to get me through for a while as I keep learning and try to get better at this. And other than that, I'm staying as his loan assistant in the meantime. And that's about all I got.
Yeah, he just took the test. He took a test that the average person fails. 60% of the average first tries fail, and he passed that test with flying colors. So he did great. He did great.
So Terrell, get on the phone, start making lots of calls, and you'll be a loan officer in the true sense.
Yeah.
No doubt. And Caitlin, do you want to introduce yourself?
Hi, everybody. I'm Caitlin. I do the marketing for Kevin and now for Terrell, which has been like chaotic. I took a year to learn how to manage one person, and now I've managed 2 loan officers. So that's kind of fun. Most of the social posts you see are me doing my magic and bringing us loans. So yeah, I'm the socialite of the group, and I keep these boys in line.
That's a very true statement. I don't know how many times my phone will be blowing up and I look and, oh, apparently I posted something, but it wasn't really me. So the magic of people. Rick, do you want to introduce yourself?
Sure. I'm Rick VML, and I'm a real estate investor. And my primary strategy that my wife and I use is the BRRRR method. We've got one successful complete. Took on a partner to do on another one, and originally was going to be a BRRRR, and it's going to end up being a flip. We're looking by the end of this month. It will be done. Out of here. I'm so ready for this job to be done, but it'll be done with a nice profit. Oh, as soon as this gets closed, and I'm already starting to look, but until we get some money back, I have to hold off on putting any offers in because there's no capital. Since the refinance on the first one was just a rate and term instead of a cash back, which is the reason why last time I asked Kevin to start looking for cross collateralization.
Yeah, and Rob and I talked about that again. And yes, we can cross collateralize. And then there's also another method, which I discussed with you earlier, where given the right set of circumstances, you don't necessarily have to have any money into the deal. So you got a couple different avenues to make that work. And it shouldn't in the long run slow you down at all in terms of capital.
Well, I know that for us, we're trying to get rocking and rolling and do, 1 to 2 a year is not enough. We need to pick that up to about 3 to 4 a year in order for us to meet our goals. I retire in about 5 to 7 years. And so I need to have that passive income supplement my retirement income.
I totally get that. And that's in a lot of ways, there's a lot of us in that position looking for those exact kind of things. So you're kind of middle of the road when it comes to that. Definitely. Kim, do you want to introduce yourself?
My name is Kim McDonald, and I live in Lewis County, so I'm an investor flipper in Lewis, Thurston, and California primarily. Yeah, just always looking for. So that's about it.
Okay. Well, Kim's done a lot of things in the recent past, a lot of flips and that kind of thing, and so she kind of took a little bit of a break, but she's back to it. So I think that she will be locating some deals here pretty soon and making it happen. Miss,
Go break and
go ahead.
Oh, just lost her.
Yeah, I just lost her altogether. In the meantime, Miss Jean, do you want to introduce yourself?
You're on mute, Gene.
There. What are you laughing at? You laughing at me?
No, I'm so scrambled and like I'm trying to let people
Don't
in.
laugh at me.
Muted.
Don't laugh at me, Caitlin.
No,
No, we
laughing with you.
My name's Jean Falb. I am a certified tax coach and a tax preparer, and I work with businesses and real estate investors because that's basically your guys' business, to try to come up with a tax strategy to help you save on taxes and protect your assets and, have an exit strategy, et cetera, et cetera.
Uh-huh. Well, and I think that you've already gotten the attention of Rick and helped him out quite a bit. So obviously your strategies are very fruitful. So excellent stuff. Okay.
Well, I'd like to say she's worth her weight in gold, but she's pretty small, so I don't know.
Do I need to pack it on, Rick?
So, Mr. Rob Apostle, actually, Song, I'm going to have you introduce yourself, and then you can turn it over to Jacob and Rob as well.
All right, thank you, Kevin. Gene, looking forward to speaking with you regarding cost segregation for tax deduction on new purchases. Today I have Jacob and Rob with me. Rob is my sales manager and Jacob is our new salesperson. We are from Pacific Equity and Loan. We're a hard money lender. We're based out of Lakewood, Washington, so definitely a South End. So we've been in business only for a couple of years as hard money lender, but we have a ton of years of experience. I started my real estate venture in 2008 during middle of foreclosure crisis, subprime meltdown. Back then, I didn't know what I was doing, but I ended up flipping like 40 houses in 4 years. So that was quite profitable venture. Then I got into hard money lending. One of our business partner, co-owner, he's been doing hard money lending for about 13 years. Rob has ton of many years experience as both hard money lender himself and also flipper. He also fix and flips. So I guess what we can say is that we bring a lot of experience, many years of experience. So we know what you guys are going through, and we can definitely help you through offering various different loan programs that would meet your needs. We have products anywhere from 0 down to low interest rate, as low as, I believe, our starting rate on a very well qualified property and borrower is as low as a 6.5%. We also have new construction and raw land acquisition that most hard money lenders do not. So we have a lot of experience, and we have a wide variety of products that meets anybody's needs. With that, I'll turn over to Rob.
You're
You're
muted.
muted, Rob.
I really need to fix that. I'll fix it one day.
Okay, while Rob's getting himself unmuted, Jacob, would you be able to take over in the meantime?
Yeah, so just a quick introduction of myself. My name is Jacob Yoon. I'm relatively new to the company and hard money lending in general. I've only been doing this for a little over 7 months, but so far I've been learning from Rob and the other managers at the company, and I've been learning a whole lot about this industry, and it's been a great time, and I look forward to learning more.
Fantastic. Well, welcome. We're glad to have you on board.
Thank you, thank you.
Mr. Rob, I can almost see your eyebrows. So you want to fill us in on your products?
Yeah, sure. While Rob's working on his microphone, I can go ahead and give you guys the rundown. So we offer anything from fix and flip, buy and hold. We have a great 0 down for people who qualify for both fix and flip and buy and holds. We do a little bit of land development as well as new construction. New construction is a little bit more of our bread and butter. We have rates as low as 6.5%. Generally, we take into account experience when we're looking at people who qualify for this program. We have worked with people who have, do new construction projects completed. However, we are looking for people, not necessarily looking for more people, but as their experience with relative projects increase, we see that people's interest rates tend to go down.
So do you guys, the industry kind of has a scale, and they look at the number of exits in the last 24 months. Do you guys kind of set yourself up that same way?
Yeah, generally 24 months is the range we look at for experience.
Okay. And as the industry goes, there's fix and flip money that's out there that, 0 to 2 units, you're going to have XYZ pricing, 3 to 4 units, different pricing. And then as you climb and get to maybe as many as 10 exits in a period of 24 months, then your pricing is different based on that. Is that along the lines of what you guys look at?
Yeah, so I guess 10 plus is kind of the highest standard for experience and exits. As far as other brackets in terms of how many projects our borrowers have completed, we look at 0 to 1, 2 to 4, and then that 5 to 9 before you hit that kind of golden 10 plus projects completed.
Okay, fantastic. So tell us more about the 0 down. I don't even think I was aware of the 0 down. How does that work? What does that look like?
So the 0 down, it's a great program, especially if you're trying to build a rental portfolio, or maybe you're starting out as an investor and you don't have a whole lot of money in the bank. Right now with the program guidelines, the purchase price and rehab budget have to be within 65% of the ARV. As far as rates and terms, it is a 9-month term for a 10% interest rate with 4 points, and those 4 points are paid up front. Some of the other requirements for the program is you need to have at least 30,000 in cash reserves that can be shown on a bank statement, as well as operating through an entity.
Okay. So somebody who is holding the property on a personal level, they would need to go get an entity put together before they do this loan.
That is correct.
Okay. And then one of the things that Rob and I talked about, and I elaborated a little bit to Rick, is if, like in my case, I'm going to do some flips of some new manufactured homes or modular homes. If we can get the seller to carry back 25 or 30%, you guys are going to cover the rest of the acquisition. In this case, there's not going to be any rehab. It's just the total acquisition. And at that point, the only thing that we're doing is making the monthly payments until we got it sold. Is that one of the setups that we can do with you guys?
Yep, absolutely.
Okay, perfect. Do you guys get, you guys said your new constructions are your kind of your bread and butter. You want to elaborate on that?
Yes, it's one of the programs that we look to, or I guess that we see a lot of our clients doing new construction as compared to fix and flip. I'm wondering if Rob would be available to elaborate a little bit more heavily. Rob, any chance you've gotten that microphone working a little bit better?
Does not sound like it. I'd be happy to jump in.
Hey, I think we got you.
Rob, you there? Okay, we don't have Rob. So one of the reasons what makes our new construction loan competitive is that, for one thing, many of our lenders are staying away from new construction and raw land acquisition for development. We're hot and heavy in that space. Also, we have one of the most competitive rates as far as raw land construction combined. So what we'll typically do is lend on raw land for development purpose, for subdivision, putting the utilities in, segregation and things like that. And then we'll also finance the vertical, meaning ground up construction. And so we're one of the few unique lenders out there that are currently offering this service.
So are you guys, I've been told in the past that hard money, if they did hard money on development of land and that kind of thing, any horizontal costs are not covered. Are you guys covering horizontal costs, permits and things of that nature?
It depends. It all comes down to LTV, loan to value, right? So we don't exceed 50% loan to value. So if someone was to, let's say someone came in with a land that they own, let's say it's 5 acres, and they can divide it into, say, 30 lots, but they have no cash. In that case, we can finance the horizontal cost. And once the lots are subdivided, then we can individually finance the vertical.
Okay. That is unique. I will tell you, because the various hard money lenders I've talked to, a lot of them won't get into financing the horizontal costs. So that's definitely an advantage.
Yes, and one of the reasons is because they are not portfolio lenders, which means they do not have their own money. We have our own 2 funds that we lend out of. So we're all the originators of the funds.
Okay, interesting. Has anybody here besides Shane and I thought about new construction? Have you thought about it, Rick?
No, but well, not from an investment perspective. I've thought about it from a private perspective, with a modular versus the manufactured, because of the standards that they're built to, and you actually get in and you do have a value up as soon as you walk in the door, because you've taken care of a lot of that sweat equity ahead of time.
Yeah.
But I haven't thought about it from an investment perspective as of yet. Oh, I will say that you have gotten my mind turning a little bit.
So the one thing I can tell you, the one loan that is not out there in the industry widespread, you'll find it at a rare credit union, but other than that rare credit union, you won't find it at all. And that is, there is no loan for a non-owner occupied manufactured home that you're keeping as a rental. So that loan just doesn't exist in the industry at all. But if you're getting into that, rather than doing manufactured, you do modular, which is still less cost than a site-built home, but you get that appreciation of a true site-built home the moment that you have occupancy certificate, and that is something that you can finance anywhere in terms of the long-term hold. Except
because once it's on site, once it's on site and it's affixed to that foundation,
yep,
then it's no longer anything but a home.
Yeah,
and it's financeable under any government program.
Yeah, it's a standard stick-built home, even though it was a stick-built home from the factory.
So one thing that I do have looked at one time, and I'm not eligible yet, but don't laugh. You can actually use a reverse. I've heard that you can actually use a reverse mortgage to get into a modular home on new land.
You can use a reverse mortgage to get into any normally financed home, and I believe even a manufactured home, you can use it as a purchase, yes.
Yeah, which I always thought was like, wow. Don't have to put...
Your down payment is... A reverse mortgage is going to only loan you between 50 and 65%, maybe 70
right.
if you're 90 years old or something. It's always based on your life, your expected longevity. And the older you are in years, the more of a percentage they'll loan you. But then at that point, you're putting theoretically 30, 35, maybe 40% down on a brand new home that you'll never have payments on. And you're always going to have equity in it when it's all said and done. So your kids will choose whether or not they want to sell it, they want to keep it by refinancing it, whatever they want to do. There's a lot of decent options for them. So yeah, a reverse mortgage is another option. Hey, Song, do you guys finance on the long-term side? Do you guys finance non-owner occupied manufactured homes?
I'd have to look into that because from what my understanding is, as long as you have a secure tie down approved by engineers and it's 1976 and younger, it's financed as a traditional home, stick-built home. And so my answer, my guess is yes, but I'd have to look into that. I have not run into that situation.
Well, what I can say is there is no financing through Fannie Mae, Freddie Mac, all the government agencies, because of the fact that it's not owner occupied.
Right.
So if you guys did do that, I could probably bring you a fair amount of business just doing that left and right, because people want to keep these as rental properties.
Okay, I'll keep that in mind. I know I have ran into a couple of different ones. I wish Rob was on voice, but I believe there is ways you can do that.
Yeah, that's what would definitely interest me more than a new construction. You go and build it out, and then you end up being taxed as ordinary income because it's a new construction. But if it becomes a rental, now I have my passive income, and I make Jean happy because she goes, there you go, good boy, you're not paying too much in tax, and you're gaining, you're only paying interest or paying taxes on what you're earning that year.
Yeah.
So that part interests me more than anything else, and there's usually a pretty good spread so that there's a decent return off the rental.
Okay, well, that might be something we can explore going down the road. Between Rob and I, we can get your questions answered on it one way or another. How about your commercial side of things? Where's your appetite lie on that type of stuff?
So on the commercial side, we go a couple of different ways. Number one is if the deal makes sense, we'll do it. But typically, a lot of the commercial deals are bigger than we'd like, say 5-6 million plus. In which case, what we'll do is we'll shop around for the best possible deal for you, because we do have a lot of connections in the industry,
Okay.
and a lot of times they can do better deals than we can.
Yeah, definitely. So on the residential side, on the new construction, do you guys limit that to 1 to 4 units, or will you go into 5+ units?
We can go into multifamily. It really depends on the case-by-case scenario. We have done larger new construction deals, but it really depends on the case-by-case, because no two deals are alike. And so when it comes down to commercial, it's even harder to put in LTV. So it really depends on the deal.
And you're still going off of an ARV on that kind of project, or are you going off a different basis?
Usually ARV is one of the key indicators. Another thing is it's also based on borrower's experience, credential, what kind of collateral they have, and so on. So it gets really quite complex.
Okay.
On the commercial deals.
But 1 to 4 units are treated with you guys just as residential. And
Absolutely.
so if I wanted to build a 4 unit, I could put the deal together and maybe I throw some money at it. Maybe I do a little bit of seller carry back, and then we can go ahead and do the ground up. And then once I got it ground up, I can refinance it off of your hard money onto conventional.
Yes, absolutely. And that would be really a smart move.
Okay. Yeah, that's interesting. Well, and Rick, I want to point out to you that they've got some great buy and hold. Well, in your case, it would be a BRRRR model, but still, whether you're going to just directly buy and hold it or you're going to BRRRR it, they've got, you guys have some long-term money in that arena. Is that right?
Yes, we can finance our longer term as well.
Okay.
Yeah, that's good, because on my first one there that we did, and we paid a little higher on the hard money costs than what I heard you talk about for your rates. But then when it came time to do the refi and get our money back out of it, things were in such a state that the only way that we could get the deal done quickly enough was to just do a rate and term. And so here I am sitting with all of this equity sitting in this house. Now, on the positive side, that does lead for some good positive cash flow, but it makes it difficult to turn around and go and get another deal.
Right. So, Rick, I think it depends a lot on individual situation, what individual investors are looking for. So just let me know if I'm going off the wrong tangent here. But what I think I understand you say is that you want to maximize amount of capital you have available and leverage it into long-term holds. And the best way you can do that is getting into, say, zero down, but you have the equity, the funds available to get, just in case you get into any problems. And because you're getting into it with zero down, you can do a cash and rate refi, in which case, what would your cost be into it? Zero down. And then you get into next deal because you still have that capital remaining. So you don't have to even worry about pulling out your capital. And I think that's where something like zero down comes in really handy.
Right. And yeah, I did hear that. Zero down makes really good sense, because then yeah, I've got equity sitting in the house, but the initial purchase of the house I put my cash into it. Okay, but on my exit, that's when we had to do ended up doing a rate and term rather than doing a cash out refi to pull the equity back out and still have positive cash flow. But doing a zero down and doing something like a cross collateralization makes sense because that money is still working. The equity is still there.
Yep, absolutely, absolutely. And I got a question for Gene on this. So this is my understanding, and I have never done this before. This is my understanding that, let's say you do a zero down. Okay, so you bought the property and you do a rate and term refi. So you got all, so you have essentially no money into it, but you're either breaking even, slightly positive cash flow, possibly negative cash flow, doesn't really matter. Likely positive cash flow. But the real magic happens when you do a cost segregation where you can do 25 to 30% of the purchase price straight off your tax, because they are for certain items that can easily be replaced or something. Gene, this question is for you. Cost segregation, first year write-off, 25%, is that reasonable?
That might be high, but I think, I'm not sure this is where you're going, but even on a residential, I have some in my group that, for $600 they can do your house. Now that doesn't seem like, cost segregations are usually reserved for big ticket, but even especially for somebody like Rick, he's a W-2 earner. He needs the accelerated depreciation. He gets a better tax benefit. I'm probably going off a tangent there, sorry. But yeah, so that a portion of it, maybe 15 to 20% is accelerated. And whether that's on a small scale or a big scale. So you're kind of capitalizing on your tax deduction, keeping the money in your pocket. If I'm following your, I'm following your logic, right?
Well, I think that confirms what I'm trying to achieve. And so you're telling me 15 to 20% cost segregation. So if the house is, say, the house portion of the purchase, say 300,000, you can write off 30 to 40,000 off your income tax. First year is just enormous.
Yeah,
Gene, I'll definitely be looking for your phone number from Kevin.
We put all of our information in the chat before we go, so you'll have everybody's. But I just think that's kind of a potentially an overlooked one for the regular investor, because if you do have a commercial building and it becomes an engineered study, now you're looking at $3,000, $4,000, $5,000, $6,000. But you can have them done non-engineered for a regular house. And so if anybody wants to talk about that, it seems worthwhile because you get that return year after year for the accelerated depreciation. And zip it now.
Well, and I want to follow up with the questions on that, because I've been interested in cost segregation. The issue that I've ran into is I could never get a defined cost as to what something like that might cost. And the answer was, if it's small residential, you would spend more to get the report done than what it might be worth for you in the long or short and long run. The other thing too is I've heard of some cost segregations not being accepted by the IRS at times, that they feel like some things weren't depreciated in the correct manner or something like that. So could you speak to those areas?
So I have not had that happen. I haven't done a lot of cost segs, but you're right. If you use a true engineered cost segregation study on a residential house, the return is not there. What I'm talking about is a company, and I'm going to have to look them up because I can't think of the name of it right now. So they offer a study. It's abbreviated. It's not very much money. And if you get audited, they will defend their study.
Okay.
Okay, so it's more observational, if you will. They're going to look at the house from afar. They're going to look at your property records. They're going to look at pictures and make a determination based on that. So it's not as comprehensive, not as expensive, but you still get the accelerated depreciation.
That's nice.
Does that
That's
answer your
interesting.
question? So
Well,
I'll be frantically looking that up while you guys are talking.
So now in that though, they determine based on, what the lifespan is for carpets, for example, lifespan for the roof, lifespan for the windows, and they apply a depreciation rate for each of those items,
So
rather than 27 and a half years
right,
for
and
everything combined.
they'll take your sidewalk, or not your sidewalk, but your your dirt work. That's something that's separate. But you're right. The idea is we're segregating the asset into different class lives, and depending on what that class life is, it's those that can be depreciated at less than 27 and a half are.
So because you're picking up more depreciation, if you had a property that was not cash flowing quite as well as maybe a different property, that would help boost your return on that property in a given year because of the fact that you're recapturing more of that money.
Correct. So again, it's and I'd be glad to put this together. I did an experiment a while ago of I just used a FACO W-2 person, and with the cost seg and without, and I think the house was 250,000 or something, and it was a benefit because, as you know, you W-2 earners, it's a challenge to find tax deductions. So especially if you just have one or two rentals, it might make a difference, and it will make a difference in giving you more money back.
Nice.
So once we get caught up with everything, we have more to talk about.
I know, you run into new things you didn't even think about, huh?
Well, she's already paid for herself off of one item. So we've still got more strategies to incorporate.
There you go. Well, that's part of that golden team ticket there, All right, so we got a couple callers on the phone. Hey, Shane, are you there?
We've been having like mega tech issues. That's why you see me like scrambling, like ah. So I believe we have Rob is on one of them, Shane, and oh my gosh, I just forgot his name. It's not Corey. Clay.
Clay.
Oh my gosh.
Clay. Yeah.
Sorry.
So Clay's on the phone. Are you with us, Clay?
Oh yeah, I'm here.
Okay. Well, sorry about the technical difficulties here today. Have you got any questions for anybody for anything that you've heard so far?
No, not yet. No. This is actually one of the most more interesting ones for me because I've been really curious about hard money, and there's a lot of bad information out there online and a lot of crazy stuff in the wholesaler communities, and I'm trying to ignore all that and get most of my information here straight from the horse's mouth. So this has been great.
Well, I can tell you I've done a number of hard money deals over the last few years, and there is misinformation out there. I'll definitely tell you that. But if you know the right hard money lenders and how to structure the deals, it's actually quite good. You just need to be prepared for a couple of things, and once you're ready to go there's really nothing that I much prefer my local hard money than any national fix and flip type money. National fix and flip, here's what I tell everybody. If you're going to do national fix and flip, the very first time you do it, you better prepare for at least 3 weeks on the closing. And if you compare that to local hard money, I can close a local hard money as if I had to in as little as 48 hours, and I've done it before.
We've done it before.
What's that?
Wow.
Yeah, I had one deal. It was actually a deal that I was involved in. I was running up against the deadline, and from the time that I got off to the hard money to the time we funded was 48 hours. So
That's amazing. Yeah, that's absolutely. Yeah. So yeah, really, I'm just sitting in and taking notes and that kind of stuff and doing a little bit of math and seeing what all this, does cost from the 300,000 place and all that kind of stuff, right? Yeah, just yep.
well, I'm telling you, with Pacific Equity Zero Down program, boy, it doesn't get any better than that. And if you're able to keep your cash in your pocket, and maybe you're going to use your cash for different things, maybe the monthly payment while you're holding it until you get it sold or whatever, that just opens the door in a big way for somebody to jump on a deal that they weren't going to do, or they couldn't do in the past. Or maybe they would in the past have to pair up with other investors to be able to take down one deal. Well, now all of a sudden, maybe they could just do it on their own. So it's definitely not a fear thing. It's just a matter of getting with the right group of people, putting the deal together. You put it out on the table as to what you're hoping to see. They'll come back and tell you what they can do. And in between, there's a deal. So it's just a matter of making it all happen. And that's why I like my local hard money. I mean, it's not that I'm against national fix and flip money, but you're dealing with a whole different animal. You're dealing with a lot more documents on that side of the fence as opposed to local. It's just so much quicker.
Sure. Well, and in post-COVID times, there'll be people you can actually go and shake their hand, right?
Yeah, absolutely.
Yeah,
so
makes a difference to me.
Well, and that's how Rob and I got connected. We got connected through a local real estate investment meeting, probably, I don't know, 3 or 4 years ago. And Rob and I have been doing deals ever since then. And there's a lot of advantage in being able to see the person that you're working with and that kind of thing. And so it's really, I like that aspect of it as opposed to the national side of things.
Awesome. Yeah. No, I'm trying not to get stuck into looking at Zillow because I just bought a house in June, and I'm watching my equity go up here, and yeah, absolutely, it could be some really fun stuff. I'm getting numbers, online anywhere from, I could be in the $40,000 range of equity built up in this thing already in the past 6 months, and that could be really exciting. So yeah, I'm gonna start seeing what I can do. I'll probably wait another 6 months, but then, yeah, I'll be ready to put some collateral up and then start doing some stuff. It's gonna be, yeah, I'm excited.
Well, and like we talked about before, it's not even necessarily that you need to put it up or pull it out and use it as cash. You could potentially cross collateralize it, and then that way it's just a lot quicker, easier deal for you. But you're using that equity to your leverage. You're able to leverage that into a deal. Instead
right.
of
Right. Yeah. Whatever the correct language is for that. Yeah. Exactly.
Yeah, fantastic.
So that does bring me a little bit back to circling back to your zero down. So 65% ARV, 4% upfront, 30K reserve. Now, did I hear that right? That's 30K cash reserve.
Okay, so sorry, let me jump in and clarify that. When we say 30K, it does not have to be $30,000 in your bank account. It could be a line of credit. Immediately accessible cash is what we're looking for, just in case something goes sideways on your project.
Okay. So it has nothing to do with the potential of cross collateralization.
No, yeah, it's not. It has nothing to do with cross collateralization.
Okay.
But if you get cross collateralized, then technically it wouldn't be a zero down. It would be
right, because that's putting a lien on the other property.
That's correct. Right. So we're talking 2 different programs now.
Okay.
So one of the things that most investors should always have, and something that you should probably look into, Rick, would be line of credit, a HELOC. So if you took out a HELOC on your home, you're not sitting, when you don't have any money drawn out on it, there's no monthly payment. That's the beauty of it.
Right.
But if you, like in this case on the zero down, if you had the HELOC and you had, say, 20 grand available on the HELOC and maybe you had another 10 grand sitting somewhere else, that meets their requirements for the 30,000. It's not that you got to spend it. It's not that you've got to use it in any way. It's just you have it available in case something happens.
Mhm.
And then that meets their requirements for that particular program.
Evan, you're exactly right. Thank you for clarification.
What kind of loan to value can we look at for like a long-term hold?
That was more for a question for Rob, so we'll have to get back to you on that one.
Can you hear me?
Yeah.
Oh, okay, great. Can you elaborate on that, Kevin?
Okay, so I could have it wrong. It seemed to me you and I talked a little bit about some programs that you had for long-term holds for rentals. What kind of loan to value does that look like?
So yes, so we have a 30-year product. Usually we want to see 75% or less loan to value.
Okay.
And it's based on, again, your experience, credits. We don't look at the debt to income ratio, but we do have an appraisal, and we look at an appraisal in this way: not only value, but we also want to see what the rents are in that market.
So are you kind of going along the lines of a debt service coverage ratio type loan?
No, we don't have a debt service coverage ratio, but they just want to know that what you're looking at. So, for example, if you have a home and you're a rental and you plan on renting it out for $2,000 a month, but in the appraisal it shows 15 to 2,000, then you're at the max. That means they're only going to use that max as for what the max rent can be for that area.
Now, what if they had a lease at 2,000?
That's fine. They just don't want to see things that are kind of like a red flag. You know, the market shows it's 2,000, you're getting 3,000. There's got to be reasons behind that. Meaning maybe it's a waterfront property, or it has a ADU, something like that. That explains the reason why the rents are higher.
So are they looking at it from the standpoint that the rents need to at minimum cover the mortgage payment, or does it have to cover more than the mortgage payment?
It needs to cover at least the mortgage payment.
Okay. So it's kind of like a debt service coverage ratio loan. I have those available through my portfolio. But I can do that more on a local level, probably a lot quicker, a lot less headaches in terms of the paperwork if I did it through you guys. And you guys are offering stuff or rates on that as low as, where would that fall?
4.25.
4.25. Why in the world would anybody go to anything else other than that? I would not do I could do a conventional loan at slightly better rates, but I'm telling you, I would only beat that by 0.5 point, maybe. So why would I jump through all the extra hoops of all the extra paperwork and the length of time to do the loan if I can get 4.25 by just going to you and I'm maxed out at 75? I'm maxed out at 75 on a conventional loan anyway, and I could just get the whole loan done quicker and easier through you. That's a no-brainer.
Can I ask a question, Rob? How do your fees compare to, I'll say, a conventional loan? I don't know if that's a fair question or a fair comparison. Closing costs.
That's a good question. Kevin, you were saying something? Or
So if I do a refinance, it depends on the loan size, but our closing costs with title, escrow, reserves, appraisal, and everything else, when it's all said and done, you add up all those closing costs, we're somewhere between $5,500 and $6,500. And then if they want to buy the rate down from there, then there's additional costs for buying the rate down from there. So my guess would be that Rob's going to be in that territory, but it depends on the loan size.
that's exactly, but it's more, we're going to be usually around 3.5% to 4% of the loan amount.
Thank you.
So it's a little bit more.
It's not dramatic, though. Honestly, it isn't dramatically more.
Well, and that's really not even a fair comparison because it's a different product, right? It's not
Yeah,
a conventional product.
Yeah.
So it
There-
has a,
where you're going to run into things where this becomes a huge advantage. Let's say I've got a borrower that is having difficulty debt ratioing through traditional means. I could run that to Rob, and they're not going to really look at that person's individual debt ratio. They're going to look at, does the rent throw off enough to cover the mortgage payment? And does it seem reasonable for the area? And are the loan to values correct, and things of that nature? That's what they're going to base their opinion on, or their approval on, as opposed to your Fannie Mae, Freddie Macs, where we're going to look at rental income. If we look at rental income in two ways. We look at it from the standpoint, let's say it's not showing up on the tax return yet because they picked up that particular property since the last time they filed their tax return. So it's still not showing up on the tax returns. We're going to pull that information off the lease, and they're going to get 75% of the gross lease minus whatever their PITI mortgage payment is. And that'll either end up in a small negative balance or a small positive balance. If it's positive, it adds to their income. If it's negative, it adds to their liabilities. That's one method. The other method is if it shows up on their tax return, we're going to go down through the tax return and show all the expenses against, show the revenue, show the expenses, and then we're going to add back depreciation as income, and whatever that final number comes out. If it's positive, it's income. If it's negative, it's debt, but it fully offsets the full debt of the mortgage. Rob's going to do it a lot easier. He's just going to look at, does it meet the loan to value requirements? Does it meet the requirements that the rents throw off enough to cover the mortgage payment? If so, and if all other factors are good, it's an approvable loan, roughly 4.25, and you got your points, and that's it. The other thing I want to say about points is points are tax deductible. So if somebody is close to itemizing, or they are ready or itemizing, they can write off those points.
and that is a real challenge anymore because of how high the standard deduction is. So much is without a tax plan, some of that stuff just gets left on the table. You know, you can't, I can't, your example is one thing, but so Rob, when you say mortgage payment, do you guys hold escrow, and are you talking PITI?
Yes. So
Okay.
there's in these 30-year products, there's a couple options, and then we're going to give you 3 to 4 of those options. One is the standard rate, 30-year rate and term. Another term could be if you want to do, for example, a 3, 5, or a 7-year term, which is interest only, and then it converts into a 30 PMI for the remaining.
Okay.
Nice.
And the reason why some people choose to go that route using the 3, 5, 7 is more because it's interest only. It gives that landlord or the investor at the time to kind of capitalize, make some money, and then move on. Maybe increase rents at that time in 7 years.
Yeah, and that's where when you have a deal that's kind of on the edge, does it make money? Does it not? That might be a good, like Rob said, good time to take a look at that 3, 5, or 7 interest only, because you can capitalize, get the better cash flow off of it, knowing that 3, 5, or 7 years from now, your rents are going to be higher than what they're at today. So you kind of bridge that gap for when you're kind of getting a smaller cash flow on a monthly basis. And then at the end, you're in a different position, and now all of a sudden it's cash flowing even more. Plus, you've gotten the appreciation on it for the last 3, 5, or 7 years. And we know that, if at 7 years, you could have almost doubled your value. So it's kind of a cash flow play, but it's also an appreciation play.
Well, and as hard as the way the market is right now, sometimes it's real difficult to locate a property that's going to give you the 1% rule. Where your rent's going to be 1% of your the value. So it hedges you for a few years while the rent catches up to where now you're at a positive cash flow. The first couple of years, you may end up being, you would be, if you were paying full pity, you would be at a negative cash flow. But after 3 years, now you're probably at break even. At 7 years, you're solid into positive cash flow. And then you can either go ahead and convert to the 30-year or do a refi, or decide to go ahead and 1031.
Definitely. Speaking of 1031, we've got a meeting coming up. Caitlin, I don't know if you can tell us, is that the next meeting?
Yeah. Hold on. Let me be more confident.
There was a lot of confidence in that answer.
I was literally just getting ready to prep my stuff that I have to say, but you caught me a bit early. So hang on, let me look.
I love how Terrell lost the hat. See, like last time he wasn't a loan officer, but now he is. There we go. I was concerned that you were getting snooty because you were licensed now.
Oh, no.
Okay. All right. I feel better.
He'll wear the hat more as he becomes more experienced.
I have 2 things that I want to recap in the earlier that I missed regarding commercial financing. It's a whole new beast when we talk about financing for commercial. So it all depends. That's a conversation that I can have with each of you individually, because we want to talk about, how many units is it commercial? When it's commercial, is it a commercial tenant, like mixed use, or is it commercial meaning industrial, retail? Is it ground up new construction of commercial? And then when it comes down to that, is doing them in phases, and then you have to work in working with Kevin about FHA financing, if it's condos regarding commercial.
Rob, can you elaborate on your geographical region?
Yes, we prefer to be along the I-5 corridor of Washington State. Does that help, or would you want to be more specific? What's that?
Have you considered opening up to Grays Harbor? Rick needs a friend.
Yeah, I've taken that in consideration.
24% market increase this last year.
Yeah, actually, Rick, while you were talking before the meeting, I was actually looking at the stats on MLS, and yeah, you are correct. It was 23.75. It was 23.75 in a year change. Yes.
Yeah, I need a friend.
Yeah, Rick needs a friend. Rick's gonna work on his next deal in the Olympia area, I believe. Is that what you're still planning
Well,
on?
unless I can get a friend to continue helping me in that high return market.
Yeah. Well, I'll talk to Rob. I'll keep pushing on him and we'll soften him up.
Okay. I have a much more confident answer this time. Our next meeting is April 13th, and it is Kyle Williams, and he is a 1031 exchange person.
Exchange facilitator.
Facilitator. There you go.
Yeah, he's not an exchange.
Well, I was like, is it broker, realtor? Like, I don't know how that works. He's a person, but
I saw him on another forum and it was an awesome presentation. I think you'll be really happy with him.
Yeah, I called my title company, one of my title companies I use all the time, and I knew they had a guy that helped them do all that, and they recommended Kyle. And so I reached out to Kyle, and he's going to be our presenter at the next meeting, because 1031s, there's a number of misconceptions on those, and then people kind of get lulled into, oh, well, I've got 6 months to make it all happen. You don't. You have 45 days to identify your properties, and they have the remainder of the 6 months to close on those properties, and no money can hit your hands, otherwise it gets taxed. So very, very specific information when it comes to those, and it takes the right person to guide you through those. So, and Rick, I think you went to Julia's meeting not too long ago. She did a 1031 exchange. Is that correct?
Yeah.
Was Kyle the presenter on that, or was it somebody else?
Yeah, I think it was.
Okay.
he might be
Good.
there. Like,
Really good information. Oh, that's all right. It won't hurt for me to hear it again.
Well, that's good though. These guys are very specialized, and they know what they're doing. And honestly, you got to keep the pros where, let them do the job that they are meant to do. I couldn't possibly think about doing Jean's job. She couldn't do mine. Vice versa, Rick, and certainly Rob. Holy cow! And the rest of you guys specialize. You do what you do, and you do it for a reason. And that's why we go with the pros. So, Rob, what are you seeing out there for the most part? What kind of loans and deals are you guys doing? What's your sweet spot right now?
Well, as Jacob explained, we are moving towards right now our bread and butter is new construction. And the reason why for that is, finding properties has been very difficult for flippers. Also, when you have wholesalers to even auctions, it's just getting very competitive where they're flippers just can't control and get their profit margins. So they move towards those the new construction where they can actually control a little bit more of their profits.
Even that, Shane's on the phone. He hasn't said anything, but Shane's one of the guys that I'm teaming up with, and just finding the properties that would financially pencil out, that has been kind of difficult as well. There are properties, but you've got to watch your costs, and there's a lot of different kinds of costs, especially on the dirt work. And are you, is it a well water? Is it septic? Is it city connections? The permitting process, the roads, is the road adequate to get the home up there and that kind of thing. So it's a different animal, but honestly, I think to me, I can foresee what the costs are going to be a lot quicker and easier than I would on a flip. Rick's got some good experiences on the flips. He's going to know that cost structure a lot better than I would. So it's just a matter of where you kind of spend your time, where you learn. But I'm anxious to get it going. I know Shane's anxious. They're going to continue. Shane and Lane and Justin are going to continue to do their normal flips. We're going to look at this as more project management. We're not so hands-on on it, but we have to oversee it very closely because money can get away from us very quickly if we're not keeping an eye on the ball there. So, and Terrell's going to jump in there and help me out on my side of the fence too.
I'm gonna make sure all this gets organized.
Oh my God. We call her the Kraken. We call her the Kraken for a reason.
Because she keeps cracking the whip on you.
Yeah. So she came up with my my nickname the other day. I'm Daddy Great White Shark. And now that Terrell is a loan officer, he is baby loan shark. Da, 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 baby loan shark. So,
Hi.
You guys are too much.
One of the things you mentioned project management earlier, just a few minutes ago, and I think about the experience that I've had in the last year with this real estate, and it's a lot of fun. It really is. But in my W-2 job, it's a lot of project management. I do IT and for the state, and for what I do is mostly project management. I don't write code anymore. And I'm finding that with my real estate projects as an investor, I have to do the same thing. I have to be on top of my folks and set the expectations, hold them accountable to those expectations, and then act accordingly if they don't meet those expectations. And it's been a little bit of a mind shift because, the last time I was in the construction industry, which was before IT, which was like 30 years ago, hey, it was just fun swinging a hammer. Well, it's not just because it's fun swinging a hammer. It's a whole different ballgame than nailing some boards together. It's all of the scheduling and knowing what your backup plans are. Like today I had to have a backup plan for a countertop that I was told was going to push me out 2 months in order to be able to list our house. And we're going, no, that'll mean that my countertops now cost me $10,000 rather than $5,000 because of the additional holding costs. We got to take care of. But it's being able to adjust to that and get to it. Oh yeah, this is really more, as an investor, it's more about project management than it is swinging a hammer.
That's the fun part for me. I'm like, I want to see the work be done and pick the countertops and paint the walls, but finding it and actually doing the construction, I'm like, no, thank you. Let me just be your interior designer, okay?
It's even more than interior design.
Oh, I know. It's way more than that. And I'm just like,
yeah, because one of the things you learn is you got to put that property together that appeal to the mass.
Yeah.
Not what appeals to you. Yeah. What I like personally isn't necessarily liked by the mass, and I have to market to the mass.
What do we know about that, Terrell, and your orange walls?
Hey, my orange walls are beautiful, okay?
In your opinion?
Yeah, no, it was when I walked in my house, when I bought it, I walked in there to these just bright, raging orange walls, and I was like, yeah, all right, I like this place.
Oh, see, now I would be going there and saying, yeah, I like this place. That's a 20% reduction in price.
I've been saying, like, if we want to rent out this place and move on to our next place, then we're going to have to paint the walls because not everybody's going to like the orange. Like, he's like, but it's great. I'm like, no, it doesn't appeal to everybody. Like, that's how this works.
Hey, Kim, so what do you think? You think you can make some zero down deals work or some buy and holds at 4 1/4?
Yeah, I think so, Kevin, as long as, I just give you a call and you tell me what to do. 'Cause I get a little bit lost in all the lingo, both the, just, and I've been disconnected like four times, and I had to step away, so I have not gotten the whole gist of things, but, I do, you know me, I get a little bit, flustered with all of the finance lingo that I'm not totally familiar with. Same thing with tax information. So as long as people do to call upon and guide me, you bet. Because
Yeah, definitely. Well, you and I will follow up and
Yeah,
She's off.
do that. Sorry, I lost her again. Sounds like I need to introduce her to Jean as well. So
if we need an interpreter, she doesn't know all the lingo, but as long as things are getting done, that's great. And yeah, she does Lewis County, right? Lewis, Thurston, Clark County.
I'm not sure if Kim's getting into Clark, but I know
Cowlitz is
the
what she
Cowlitz,
said.
okay.
That's what-
Cowlitz and
Yeah, but
Lewis and Thurston. Yeah.
tonight's not been the night for everybody getting connected onto here. So we're just glad that you can hear us.
Yeah. I live a bit rural, so my internet is a little bit sketchy sometimes. I'm on the waiting list for Elon Musk's satellite, and
Oh, really?
I've paid my deposit, so I'm hoping I get that satellite here pretty quick, because everybody that has it here in town says it just rips. So I'm very anxious to get that, and Terrell's got one coming too, so we're hoping that we're going to have better internet at some point in the future. But honestly, I really want to get back to face-to-face conversations.
Yeah,
I
have
know
you contacted them yet?
They sent me a refund recently, although
They're
they sent
done
it
until further notice.
to Geneva, so I've got to get them to cut it a new check on that. Caitlin, that's a footnote.
Okay.
Remind me to call them to
Yeah,
get that fixed.
I'll just email them. But well, I guess you need to call Geneva. But face-to-face meetings not happening anytime soon, even with the mask mandate lifting for some reason. I have talked to them in the last month. They gave us a refund and said just call back when you're ready, or like later down the road. So they're not thinking any sooner than June. June, July, sometime this summer, maybe even into the end of the year. This 2020 is not looking promising for in-person meetings, so we'll have to work around that. I know, Rick, you've offered your place as well. Yeah, no, it's going to be interesting to see us progress into an in-person meeting and what that looks like. With that, we're also still going to be doing digital because there's still interest in that. I know a lot of people are like, oh, I'm so over Zoom, but like, I don't know. Terrell and I were talking about this the other day, where like millennials are super into this because we don't want to go out and do things. Like going out or staying in is everybody's favorite thing now. So Zoom is great, but in this industry, it's not great. So we have to find like our new clients that are coming in, our new investors, but still entertaining the ones that have already been in it.
Hey, Caitlin, can you elaborate on having everybody put their contact info?
Yeah, so if you guys could put all of your name, business, phone number, and maybe an email into the chat box, or email them to me directly, they will go into a directory that goes out the Friday after, or at least by Monday. And I just copy and paste the information. So however it's in there, that's how it's going into the directory. Just gonna asterisk, cover my butt this time.
Yeah, so change mine to, I forgot an L on the business name.
Yeah, I think I fixed yours last time. So I'll just double, triple, quadruple check. But yeah.
No, I'm talking about what I just typed in.
Or if like the people on the phone, if they can email it to me later, It will go in along with, we are becoming much more active on our YouTube channel. So I know Kim's not here right now, but she was saying like, we're really overwhelmed with the lingo and I don't really understand, or, you know, what are the baby steps to these different processes? We are now doing short videos about the mortgages and investing and just across the board. So there's a lot more activity there. And part of being a presenter is this gets put on YouTube for you guys to use as well. And we kind of help promote you guys as a team on our side as well. So.
Yes. So, and the thing about this is on each individual meeting, we don't know who's going to show up, but we've probably got 50 to 60 unique different people that have shown up to our meeting one way or another. So the registry is still small, but it's not as small as, you know, the group that we have here. It's a much, much larger group than what we have here today. So at least if your information's in there, you're going out to all the people in that directory, all the people that we have on emails. And so you're going to get a lot bigger, wider audience than what we have even right here today.
Yeah, I think that's my favorite part about the style that we do for this is, yeah, it's who's here, but then it's also, you know, oh, I missed it because I had a soccer game. My kid had a soccer game, like whatever it is, they can watch it later. And all of our videos are starting to come with skip through menus. So you can skip through the intro and go straight to presentation. And, you know, they're pretty friendly in that format as well. So it's a great resource to learn some of our stuff about what we're doing that week, on top of being included in the meetings that you missed.
What we're also doing, I wanted to elaborate, Caitlin and I and Terrell eventually is going to jump in there and probably do some as well. We're doing, from the mortgage standpoint, I'm doing weekly topics and I'm doing videos. We're publishing out daily posts on that. And then I followed up with once a week video talking about that overall subject. That's going out on my YouTube channel. That's going to draw different eyeballs. And once people are in the YouTube channel, they can have access to these meetings. And we are finding that people are jumping over and they're looking at some of these meetings. Matter of fact, these meetings have gotten more attendance, more eyeball views than some of my other posts that are going out. They're getting views, but they're not getting quite as many views as these meetings. So even after the meeting's all said and done, people are kind of viewing the information and they're getting ideas and they're getting some plans put together as to how we can do some things. It just depends on what they want to do and you know, which meeting might kind of hit their likes and dislikes. So
yeah, YouTube's been a very interesting resource, but we're definitely picking it up a notch and trying to be active in front of everybody and making sure everybody's working together in all the ways that we can.
yeah, absolutely. All right, Rob. Well, I plan on bringing you a bunch of new construction myself. I know Shane plans on it too. He's dropped off the call, but he's going to be part of it. We've got a meeting actually set up with the dealer tomorrow. We're going to go through some details with the dealer, and they have already wanted to put some land under contract, and I just was kind of holding off and saying, hey, let's talk to the dealer. Let's get some ideas of costs of the homes and dirt work costs and things like that. Let's get a few more pieces of the puzzle before we go throw in some property under contract. But I bet you $1 million we got a property under contract before April hits. So
well, good. I'm glad to hear that. Are you guys working with Imperial?
Yeah, we're gonna go over and meet with them tomorrow and walk through some plans, walk through some cost structures, and then once we get a better feel for that, that'll give us an idea. We have an idea of what the completed sales price would be for a given home in Lewis County, Thurston County, Cowlitz County, and Clark County. Clark County is pretty amazing. they're getting $500,000 and $600,000, maybe as much as $650,000 for an 1,800 square foot manufactured home on land down there. It's interesting. So Lewis County, I'm roughly 350 to 375. Cowlitz, I'm 375 for. Clark, I'm 5 to 650. Thurston, I haven't really searched it out that much yet, so I still need to do some details on that. So bottom line is, we know what our profit will be, so long as we can know what our costs are going to be up front.
Yeah, Thurston's going to be really challenging. I've been talking with the county over there, and even on replacing existing single manufactured homes, you're going to have to go through a gopher study.
Yeah, that pocket gopher.
And they only do that twice a year. Yeah, twice a year. So the earliest one that you can do a gopher study is June 1st, and it's a 16-week wait.
Wow, that is crazy.
Yeah. More so, I honestly, it's better just to skip. I hate to say it, even though I live in Olympia, but skip Thurston. Or if you're in Thurston, go where, bodies of water, where the ground is more of a clay mud. You'll have a better chance of doing the gopher study.
What about looking at East Grays Harbor or Mason?
Well, East Grays Harbor or Great. Well, are you talking about regarding the gopher study?
No, I'm talking about what Kevin is talking about. Avoiding Thurston and looking at East Grays Harbor or Mason, although they're not on I-5 corridor. East Grays Harbor isn't so bad.
Yeah, Kevin and I and Shane and Lane, we had a conversation a few weeks ago, and Lewis County is your best bet, unless you go further down to like Cowlitz or Clark. But as for what's happening for Lewis County, your best buck is going to be there.
I believe it. And I think that the pricing, when I'm at 350, 375 right now, I think 6 months, a year from now, it wouldn't surprise me if I'm seeing more in the 4.25 range. And it's all going to come down to me knowing my costs in advance, know what a particular house plan is going to cost me, know what the dirt work is going to cost me, know what the land is going to cost me, and the permitting and everything else. And once I get all the final numbers down, and then of course I know my selling costs, that will tell me what my final profit level is going to be. Right now we're shooting $100,000 a home. So if we can hit $100,000, even before we get into our selling costs, I think we're good at that. That's 4 of us splitting maybe $78,000, but that's still $23,000 a piece. We're rolling that money into the next deal, into the next deal, into the next deal. The real dollars come when we get volume going. So, and Rob will let us get volume going so long as we have the proper reserves. So, but we want to get through the first 1 or 2, understand, because there's going to be things that we're not going to anticipate up front, and we're going to learn as we go through the first 1 or 2. And then after we get to the point where we kind of know what the hiccups are and know what the bumps in the road are, then we can kind of plan for it and work around it and maybe resolve some time issue things and just dial in that profit. And then once we get to that point, there's no point in doing just 1 or 2. We might as well do 3 or 4 at a time. So
yeah,
and it solves
one
the
thing great about
issue.
Yeah, and one thing great about Lewis County is, from people that are moving from Pierce to Thurston, Thurston to Pierce, it's all about affordable housing.
Yeah, and who would have thought that 350 to 400,000 is considered affordable, but that's your affordable housing.
Yeah, right.
No doubt.
Well, I have a long-term friend of mine that we're doing a loan for, and I happened to bump into her at the store the other day. And I asked her, I said, well, so how's your house hunting coming? And I got her approved for the FHA max, which is $369,000 in Lewis County. She goes, the problem is, Kevin, she goes, everybody else in the world is in that price range that we're in. And she goes, so yeah, 369 in Lewis County, in theory, you should be able to do just fine with that. But the problem is everybody's in that price range and we can't get a deal. And so that's part of that upward push. Yeah, I think we're going to see some cooling off effects because of the people that are in forbearance. But I don't really think it's going to be a huge cooling off effect like everybody thinks it's going to be. So I'm going for it. I think I feel good about putting some inventory out there, and it being a bright, nice, shiny penny. We shouldn't get a lot of pushback. Get it sold, move on to the next one. I'm anxious for that meeting tomorrow, so we'll see. Well, anybody else got any other questions? Jacob, you've been pretty quiet lately. I haven't heard much from you.
Yeah, I've just been listening and acting like a sponge, trying to soak up all the knowledge I can get.
Hey, I love this business, man. It's so creative. If you could think about it one way or another, you could probably get it done.
Oh, for sure, for sure.
That's how we
All
now have
right.
a baby loan shark. He sucks it all
Yeah,
up.
we have a baby loan shark. I'm gonna I threatened to do a video of him to the baby loan shark sound, but I haven't put it together yet.
So we'll just call him like, if Kevin is the great white, then we'll make him the cookie cutter shark.
I like the baby loan shark. We talk about interesting things during our morning meetings, that's for sure.
Okay, well, on April 13th, we have our next meeting at 6 p.m. You'll see me post about it. I'm sure I will annoy one of you eventually with it. And we have a YouTube channel. It's at Kevin Romines. You'll see the rest of our content is in there to learn about different topics. Definitely subscribe there because that has so much more information coming out of it. South Sound Real Estate Networking is our Facebook page, and make sure to join the group. There is a quick questionnaire to fill out first, so make sure you fill that out. And I think that is it.
Yeah, I think we've covered it. We're finally starting to get some videos rolling, and certainly the video. One of the things I like to do is, like, if there's a channel that I like to watch, I like to go back to their first videos and watch and see how bad those videos are compared to their current 2 years later videos, right? And so we're susceptible to that too. So if you look at our first videos, we're pretty bad, but I guarantee you it'll get more and more interesting as we go. So Caitlin cracking the whip on all of us, it seems to work.
Somebody's got to.
There you go. All right, guys. Well, if nobody has any further questions, thank you. This is incredibly informative. Thank you, Jacob. Thank you, Rob.
Thank you.
And we will see if we can get some business going your way there, Rob.